Even before getting to trade wars, South Korean GDP contracted in the first quarter of this year, which meant that output was down for the entire year leading up to tariffs. This was worse than was expected and has created a mini panic among South Korean officials who have haphazardly slapped together a massive bailout program, especially for the country's key industries. The Bank of Korea, the nation's central bank, is now near certain to lower its policy rates even more than had been anticipated. If, or rather when it does, it will become the next of the world's major central banks to race to the bottom. And BOK isn't that far from historic low territory already, and with the economy this week to begin with, ultra low rates are increasingly on the horizon there too. Jay Powell should be taking notes. Whether he likes it or not, this is the way the world was already traveling prior to whatever the tariff shock might add to this growing downside. And South Korea is a perfect example of it. The transition into and maybe out of forgot how to grow. And unfortunately, that transition isn't to soft landing and recovery. The fallout from the fragile economy being hit by the tariff shock is coming in already from other places. There is a report now that comes from China which says factory owners are dramatically cutting back on production schedules, furloughing workers, and in some extreme cases, temporarily closing entire facilities, if only to pause and assess the damage. So in response to the darkening global prospects, over in China, the PBOC offered the most one-year interbank loans since December of 2023, even though the central bank there has been trying to move away from this facility ever since then. The economy was already fragile to begin with, and now comes along the tariff shock. There's going to be global implications for all of this. And as I said, South Korea is the best example of both parts. On the one hand, the GDP figures completely confirm the fragile, forgot how to grow economy that's existing before we even get to trade wars. And on the other hand, this is the country that said exports are down in April already and down by a substantial amount. So you put those two things together and it has the government in Korea scrambling to piece together a massive bailout because they realize the implications locally and therefore internationally are going to be pretty severe. Now, what the Bank of Korea reported, and the GDP numbers come from the Bank of Korea, was that GDP in real terms declined by 0.2% in the first quarter of this year. But you have to realize this 0.2% decline follows 3 other quarters with basically zero growth in the Korean economy. Before that, in the second quarter of last year, they had a decline of the same amount, 0.2%, which was followed by just 0.1% growth, barely anything in the third quarter of 2024, and barely anything in the fourth quarter. So for that entire full year period, GDP in Korea was down by 0.1%, which is its first decline in any annual period or any annual comparison since December, the fourth quarter of 2020. That's not tariffs, that's global fragility. First of all, you look at GDP, it never recovered in real terms from the pandemic, the lockdowns, and the global supply shock, the price illusion. It was never a recovery. And straight away, Korean GDP in real terms already started falling behind in 2021, but then it encountered the forgot how to grow downturn or inflection at the end of 2022, just like the rest of the world. That's one of the reasons why we look at South Korea, because it is a good representation of especially trade dynamics in the overall economic system. But then in the second quarter of 2024, they forgot how to grow economy, forgot even more how to grow. We have another inflection in Korea. And by the way, this is the same one that we keep running across all over the world. Last March and April, I've been telling you ever since then, something big happened and something big changed in the global economy. And here's more proof of that in the Korean system. Remember, March and April, that's when we saw, like, for example, the Baltic Dry Index start to fall off, or even just oil prices. Oil prices hit their last peak in April of last year, and they've been downhill ever since, just like the entire global economy, forgetting even more how to grow and heading toward what may be the next stage of this downswing. So South Korea already, you've got 4 quarters of basically nothing, which is an unofficial recession within an unofficial recession. And if GDP here in the first quarter of 2025 represents another inflection point, what you'd have is an unofficial recession within an unofficial recession that's already within an unofficial recession. Commentary from Korea basically stating the obvious at this point. The situation is already pretty bad to begin with, and they're not facing any positives moving forward. The tariff shock being maybe one shock too many after this recession within a recession within a recession. Jo Young-gu, a researcher at Shinyoung Securities, noted, "We expected minus 0.1%, but it was worse than expected. Considering that the growth rate has been slowing since the first quarter of last year, it amounts to effectively a year of zero growth." Moon-Hong Chol, a researcher at DB Financial Investment, stated, "We need to take very seriously the fact that the first quarter GDP recorded a negative even before the trade war started. That's the fragility." And then he added, "I think it's effectively at a recession level. As I said, it's a recession within a recession and possibly a recession within a recession within a recession, all of it unofficial and undeclared, but it doesn't matter what governments say, it's what they do." And the South Korean government, in response to the data, knowing that it was coming, has pushed into extreme measures as far as fiscal response. So when the Bank of Korea meets next month, after holding its rates here in this past month, they're going to lower their growth forecast for 2025 again. They've already basically said as much, and they've already reduced it pretty substantially up until more recently. The current forecast is for 1.5%, but that's nowhere near realistic, especially given what information we have right now. So the only real question for the Bank of Korea next month is how much lower they're going to reduce their forecast. And is it going to get down closer to zero, which is more realistic? But either way, the response to that, GDP is going to be incredibly weak anyway. So the response from the Bank of Korea is almost certainly going to be like any other central bank, getting off of their uncertainty fixation that they've got like the Federal Reserve and moving toward the more consistent central bank programs that we're familiar with. They respond to weakness, they react to weakness by lowering interest rates. And the Bank of Korea started at 3.5% rates last year, with their first rate cut a little bit later than the other central banks in October, followed by one in November, which was the first back-to-back cuts from the Bank of Korea since 2008-2009. That obviously didn't work, and it didn't help the political events with the martial law and the political drama in December. But by February, the Bank of Korea was back to cutting rates again. Then it held them last week, as I said, trying to blame uncertainty for the reason why they're basically paralyzed. And there's a possibility they're using uncertainty here. And by they, I mean both the Bank of Korea as well as the Federal Reserve, and maybe even the Bank of England and some others too. They're using the term uncertainty because they didn't want it to appear to be too panicked by the financial fallout earlier this month. So the Bank of Korea, looking at the conditions in the financial markets in Korea, said maybe we should wait until next month to make any moves. And that uncertainty really isn't about inflation uncertainty. It's really about financial uncertainty. Because either way, the overall economy gets weaker and weaker and weaker. So that raises the chances of another major central bank reaching historic lows already just in the near-term future in Korea, and maybe even going beyond that into ultra lows if the economy continues to develop in the same way that it has over the last year, with an acceleration to the downside, that second inflection after the inflection last March and April. And with all of this going on, with GDP basically confirming and then trade war prospects, the trade war shock potentially on top of it, government officials in South Korea have become quite a bit panicky. In a statement that was put out a week ago in anticipation of these GDP figures, they knew what it was going to be. What the Korean government said was more than 4 trillion won will be invested to respond to rapidly changing trade conditions and to enhance competitiveness in high-tech industries. Over 25 trillion won in policy financing will be provided to support companies facing tariff-related damages or export crises. And the number of companies receiving export voucher support will also be more than doubled. Fiscal support for infrastructure, finance, and R&D in advanced industries such as AI and semiconductors will be expanded by over 2 trillion won. Furthermore, over 4 trillion won will be provided to support small business owners and vulnerable groups. A new, quote, burden relief credit program will be introduced, offering 500,000 won per year to small business owners to help cover utility payments and insurance premiums. A co-prosperity payback program will also be launched, which reimburses a portion of the year-on-year increase in credit card spending in the form of Onuru gift certificates for business with annual sales of 3 billion won or less, so basically small business bailout. Policy financing to support the livelihood stability of low-income youth and individuals with the lowest credit ratings will also be raised by 200 billion won. So like I said, they're acting quite panicky because they realize, like the Chinese and everyone else, there's some real downside potential here, and they're already in some downside potential and have been stuck in it for quite some time already. Fragile economy meets a tariff shock means panicky government responses, including central banks, whether they want to admit it right now or not. And we're already seeing the spillovers, not just South Korea. South Korea, in many ways, is a proxy for the Chinese economy, which is a proxy for the global economy. It all fits together. But South Korea is the fourth largest economy. Its biggest trading partner is China. And a report that came out yesterday from the Financial Times shows there's already major implications, negative implications from the tariff shock and the fragile economy. What the FT said was factories in China have begun slowing production and furloughing some workers as the trade war unleashed by President Donald Trump dries up orders for products ranging from jeans to home appliances. With most Chinese goods now facing U.S. duties of at least 145%, some factory owners say American customers have canceled or suspended orders, forcing them to cut production. Workers said that the trade war had prompted the suspension of production for a week or more at plants making products ranging from shoe soles to jeans, electrical outlets, and portable stoves. Some factory owners said they were cutting overtime or even weekend work. Wang Xin, who's the head of the Shenzhen Cross-Border E-Commerce Association, which is an industry group representing Chinese merchants, said that many of them were extremely anxious and had told factories and suppliers to halt or delay deliveries. And this prompted some factories to suspend production for 1 to 2 weeks. So already fallout in the Chinese system, which you would expect given everything that's been happening. Global demand hasn't been strong to begin with, and now all this uncertainty over tariffs, as well as the tariffs themselves, of course the Chinese were going to suffer a major setback, and that was going to have global implications beyond what we already see in South Korea. As far as the Chinese government response to the growing downside inflection, the PBOC injected a pretty substantial amount through its one-year medium-term lending facility, or MLF, which was a surprise to many observers because the PBOC has been downplaying and downgrading the MLF ever since it announced its reforms a couple of years ago. According to the central bank itself, yesterday they offered a total of 600 billion yuan at the medium-term lending facility, which is the equivalent of about $80 billion worth, which, given that there's only 100 billion yuan expiring, that means a net increase or net auction for the MLF at 500 billion yuan, which is the most the PBOC has offered through the MLF since December of 2023. And this was not expected at all. Instead, the PBOC has been using shorter dated reverse repos, and there are a lot of those coming due, but now they come along, go back to the MLF, which indicates the Chinese government, Chinese central bank in any way, is looking at everything that's unfolding and thinking we need to be very proactive about how we approach the fallout from this latest shock in the global economy. As it is, interest rates in China, they've been holding them steady largely because the banking sector doesn't want lower benchmark interest rates because that would mean lower profitability for banks that can't really afford it. So they have left the loan prime rates on hold for the last 6 months, even though those were a big part of the September fiscal stimulus announcement, at least they were supposed to be. Instead, the PBOC is turning to these other liquidity tactics, or what are supposed to be liquidity tactics. China is pretty much stuck between a rock and a hard place, where the rock is the banking sector that is riddled with problems, more problems than most people are aware of, and the hard place being the global economy that was already fragile and weak and forgot how to grow to begin with, now facing the prospects of another inflection, another shock, forcing an even greater downturn. You look at the Chinese bond market, for example, just to finish up here. Long-term Chinese bond rates, or government bond rates, central government bond rates, are right back down to very near their December record lows after being a little bit higher and being run up in February into March. The 10-year Chinese government bond as of Friday was 1.67%, just a couple basis points off its record low. And even the front end of the yield curve, the 2 years at 1.5% and the 1 years at 1.48%, those were driven higher, it looks like, by PBOC policies intending to get those rates, which had absolutely plunged back in December on real flight to safety concerns, to get those rates back up where the 7-day repo rate is for China, the Chinese central bank, as a way to try to enforce the 7-day repo rate as the main policy rate from the central bank. But either way, the fact that the PBOC felt it had to intervene, assuming that's what happened, just to get short-term rates back up to the target where the PBOC wants them, shows you just how much the situation appeared to deteriorate as far as the bond market was concerned, leading up to now. Again, the fragile situation before we even get there. And now with long-term bond rates that are continuing to sink lower and lower back toward the record lows, even though the Chinese government is selling more and more bonds, tells you that the Chinese bond market looks at the current situation and thinks the same things that it did a couple months ago. That this is all, the entire world economy, the entire system is heading in the wrong direction, and nothing is changing that, at least for the better. There's no soft landing here from the Chinese perspective, which flows through the South Korean perspective, which flows into all of the rest of Asia and beyond. So South Korea, another really good example of forgot how to grow even before we get to 2024. And then they forgot even more how to grow in 2024, even before we get to tariffs in 2025. So we're starting to see how the trade war shock fits into the forgot how to grow economy, what's actually happening in the opening stages of what looks increasingly likely the next stage in it. The government in Korea is not sanguine about prospects, nor is the BOK, the Bank of Korea, likely to hold up on this uncertainty paralysis that it's portraying. And the reason why, look at what's happening in China. At least these initial reports from the Financial Times and a couple other sources are pretty darn concerning. We don't know yet how widespread these factory furloughs and canceled orders might be, or how long it might last, if maybe this is only a temporary adjustment. But when you're picturing in your mind how an economy transitions from forgot how to grow to remember how to recession, this is exactly what it looks like, especially in these two key places, South Korea and China. This is what you would expect to happen if this was happening. We've been warning about the fragile economy all this time and the potential negative implications from it. Now we're beginning to see them more clearly, and they're basically what we've been expecting. For the marketplace, for interest rates, it's all been pretty simple from the very beginning. Interest rates that go down and they stay there. And if interest rates are going to go down and they are going to stay there, this is exactly what it would look like on the way to that outcome. It also looks like what we heard from Walmart and Chipotle and US air carriers, and all of those are in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.